Derivatives Trading 101. What is the underlying in digital asset contract trading? Digital asset contract trading is similar to traditional financial derivatives trading. But unlike traditional financial derivatives trading, digital asset contract trading does not trade with fiat currency. Digital asset contracts take digital assets as the underlying. The contracts are priced in US dollars and settled in digital asset price difference. For example, when BTC price is $5,000, John opens a long position. He uses 1 BTC as the margin, places an open long order, and enters into a long position of 50 contracts. In this digital asset contract, the underlying is BTC. Then BTC rises to $5,500 and John closes the long position. After closing the position, John earns 0.09 BTC. Throughout this example, we use USD to demonstrate costs and profits. Now suppose John opens a short BTC position at price $5,000. Using 1 BTC as the margin, he sells to open a short position of 50 contracts. In this contract, the underlying is still BTC. Then BTC falls to $4,500 and John chooses to close the position. He buys to close the short position at $4,500 and earns 0.11 BTC. To sum up, the underlying of digital asset contract trading is the corresponding digital asset.